Hello, everybody. Very warm welcome to our panel discussion about fund secondaries, which we have headlined with Finding Value, different perspectives on how to find value, I guess. As you probably know, we have done this panel for a number of years and always try to identify new trends in the secondary market. And that's also the objective we are focusing on today. I'm happy to introduce the panel and to welcome our panelists. On the very left side from your perspective, we have Sunaina Sinha from Cebile Capital in London. She is founder and managing partner of Cebile Capital, which is one of the leading secondaries advisor and placement agents with offices in London and New York. Over the last 5 years, Cebile Capital has advised on over $21 billion worth of secondary deal flow and completed more than 75 transactions, if that's right. Thanks for coming. Great to have you here. On my right side, left from your perspective, we have Fokke Lucas from 17 Capital in London. He works as an investment director at 17 Capital, which is one of the leading global private equity specialists with a focus on financing successful investors in private equity. 17 Capital has raised over 2 billion euros across 4 successive funds and executed over 40 transactions. Fokke has been working for 17 Capital for, I think, 7 years now. Prior to that, he was at Neovara LLP, which is a spin-out of Lehman Brothers European's mezzanine business. And his experience includes various European mezzanine and equity co-invest transactions. Next to Tarek, we have Nico Taverna from Schroder Adveq in Zurich. Nico is the head of the Adveq Secondaries program. Before he joined Adveq, I believe about 6 years ago in 2012, Nico was a private equity secondary specialist with Partners Group, and he conducted his PhD studies at the University of St. Gallen. Nico holds a master's degree in banking and finance, and as I said, a PhD from the University of St. Gallen. And on the very right side from your perspective, I'm happy to welcome Steve Nicholls from Hollyport Capital in London. Steve is a partner at Hollyport Capital and has been a private equity investor for 22 years now. As most of you probably know, Hollyport Capital is the manager of a global private equity fund initiator. And Hollyport Capital is specialized on acquiring tail-end portfolios of mature private equity assets in the secondary market. Since 2007, so more or less over the last 10 years, Hollyport has raised 6 secondary funds, which all focus on acquiring mature private equity fund interests. My name is Amos Fayed. I work in the Berlin office of Pollard & Partners. Apart from advising LP investors in all kinds of alternative investment funds, in particular certainly private equity funds, we also do a lot of secondary transactions. The number is increasing over the last years. And on my left, I'm happy to introduce my partner Tarek Mardini, also working in the Berlin office, who's working more or less on the same subject matters. And Tarek will give some content introduction into the topic today.
Thank you very much. Also a warm welcome from my side. Happy to be here on this panel since 2012 when we started it. Those of you who may have attended prior panels know that we covered a number of topics that we try to not only find the topic of the time, but sometimes trying to be ahead of the time. And when we're looking for the new topic for this year, we felt that we actually have been quite ahead of the time in recent years. So 2 years ago, we had the topic of fund restructurings, which is probably the most important theme of secondaries in the last 12 months. So we've been a little bit ahead of the time. That's why we were not doing secondaries fund restructurings here again. We will say a little bit things about it today, but as you know, we try to split this panel, which is 60 minutes, into two parts. One is a discussion of general observations in the market, and we will also talk about fund restructurings and other observations that the panelists have on fund secondaries. And the second half is what we here call finding value different perspectives. And the idea is, maybe that's not fully clear what it is, but the idea is that not only is the market growing and getting larger in size, and I will show you in a second a few numbers on this, but we believe that it's also getting more diverse. And we believe that one of the themes, fund restructuring, will continue to grow and be a very important theme. But where people actually look for great returns, great alpha, they may turn maybe to the road less traveled, which may also lead to fantastic returns, and maybe a more niche strategy can give an extra edge. And so we found some colleagues here on the panel who have some specific edge that they can have on certain areas, and we will talk about this in the second half of the panel. So for next 5 minutes, I will just flip through, and you will get this as a download also, some numbers on the market developments in the last 12 months or so before we then head into a normal panel discussion. So when we take a quick look at the overall growth of the market, you can see that it was quite little in 2005 and even smaller in the years before. And this is here. These are numbers. You may not take them literally because you have great advisors and placement agents and other data providers who look at the numbers, and they can vary largely between 45 and 60 billion within the same year. But it gives you, I think, overall a sense of where the market is going. And actually, this capital collar-based chart is a market consensus-based, so kind of a mix of everybody's opinion. And you can see that in the last few years, the market was growing. There was a little bit of a dip in 2016, but it was not really significant when you look at the years prior to that. And it seems like we're coming up to a next plateau. And this is an interesting development that we will later talk about it. And you can see that the market is growing, and we believe it's not only getting bigger, it's getting more diverse, taking different shapes. So one of the big themes of 2017, when you look back at the last 12 months, was this theme of so-called GP-led secondaries. So as you know, a fund secondary interest transaction used to be somebody wants to get out of a fund, a limited partner, and is trying to find a buyer. But nowadays, you have a number of funds who are either coming at the end of their term or have other reasons why they might need additional capital, do a fund restructuring, a kind of tailor-made process, or some kind of other GP-led type of transaction where actually the fund manager introduces a buyer and asks the investors, actually, do you want to sell? So these are these GP-led secondaries. And one of the most motivations, we could talk about this if the panelists have a similar observation, is a portfolio reshaping or portfolio allocation. People think about the assets they hold, whether they want to keep them, whether they want to keep the relationship with the GPs. Yeah, we will look into this in a more detailed fashion. A just quick look at pricing. Again, something we will talk in more detail later. You can see that the prices people pay for a fund interest compared to NAV. So the reporting coming from the fund manager has been growing overall. You can see it was actually kind of growing with the growth of the stock market, the S&P 500. Part of it was always that these valuations, NAVs, are often lagging 6, sometimes 9 months ahead or back. So basically, you know that when you see end of 2017 NEVs and the stock market is growing since then you know, maybe the assets are also valued higher. So I think it was one of the reasons why in a growing stock market, people were willing to pay more overall, and that goes across asset classes, but it's true specifically for buyout funds. Here you see a little bit on this chart some details for pricing. This is a little bit for taking home. I don't want to go through all these charts. They will be available for download, but the idea is not only have we seen discounts to NEV, like in many other years, but increasingly, also it started in the last 1 or 2 years, you sometimes get even a premium. And this is particularly true for buyout funds, less so for venture funds, and it's also true for relatively young funds, 2012 or younger, and less so for these buyout funds also from 2006. Just one final chart before we go into the panel discussion. What kind of GP-led transactions are there? There are, tender offers, fund restructurings. You have staple transactions where somebody is agreeing to buy fund interest in, let's say, Fund 2, and also committing capital to a new Fund 3. This is one of these things. Also GP spin-outs, and I can see, I think, at least one person here in the room who we worked on a GP spin-out some years ago. But you can see that in the chart on the left-hand side, the GP-led volume of these kind of transactions increased from almost nothing to now 14 billion. So you can see definitely this is probably the biggest theme, to be honest, in the last 12 months. However, we believe that we are ahead of the curve and already looking for the new topic. So with this, I give Amos the control mic. Yes.
Yeah. Great. So let's get into the discussion. First part will be on general developments and market observations over maybe the last 12 to 18 months, and I would start with Sunaina again and really have the question: what you say? What are the main developments you have seen in the market over the last 12 to 18 months?
I think the main thing we're seeing is that the market is getting more and more strategic in terms of where buyers will spend their time, getting more and more specialized, and I know we'll get to that in the second part, so I don't want to steal all the thunder from that section. But we are seeing more and more differentiated strategies coming to the fore in terms of where the secondaries market will spend its time. Whereas GP-led transactions 3 years ago used to be mostly tender offers or restructurings, now we see more and more asset strip sales and partial asset strip sales, continuation fund vehicles, and so on and so forth, becoming more popular in the way GPs think about secondaries. Certainly one of the big themes that has emerged in the last 12 to 18 months, as you've seen the volumes of GP-led transactions go up, as you've seen some of the big names in the industry like Warburg Pincus or BC Partners do GP-led transactions, is the fact that now other GPs, mid-market GPs that have fund sizes of 200 to 500 million euros are saying, I can actually use this market as a tool. What do I need to solve for? Do I need more time in my portfolio for the assets to mature? Do I need more capital, follow-on capital? Do I want to engineer a secondary staple? How can I use this market as a tool? And then in terms of the buyers in the market, we're finding them becoming more and more opportunistic on strategies that they wouldn't have looked at in the past. So one of our big themes in the last 6 to 12 months is the emergence of single asset deals in the secondaries market. 3 or 4 years ago, if you took a single asset deal to a secondaries buyer, a couple here and there might have looked at it, but most would have said, no, I need a portfolio. In the last 6 to 12 months, we've seen a number of deals in single companies trade on the secondaries market. These can be preferred shares in unicorns like WeWork or 23andMe, or it can be in single buyout companies that need liquidity for certain co-investors. So that's becoming more and more of a trend in the last 12 months than we've ever seen before.
And that is a direct business, so they're buying into operating companies directly and not in fund stakes anymore?
That's right. So they're cleaning out shareholders in direct companies. So, for example, in some of the unicorns, what's happening is that they're setting up SPVs to buy shares. As you know, more, especially in Silicon Valley, more and more of these companies are staying private for longer. So therefore, if you're not going to have an IPO, there is going to be a subset of your shareholder base that needs liquidity. And that's where the secondaries market has come in, saying, we'll put together an SPV to buy up employees who've departed their shares, or your Series A or seed investors, and now you're at your seventh round of fundraising. That is becoming more common, as well as in Europe. We've now done 3 single asset deals in Europe, where it's been a transaction that's needed, where someone has needed additional follow-on capital in one single company because there's a transaction happening there, or a prior shareholder needs liquidity, and the way the secondaries buyers are approaching it, I mean, we've got 3 on the panel and they can comment more, is they're saying, listen, we can build that diversification into our own programs ourselves. We can do several of these and build that diversification in for ourselves. If we like the look and feel of this one asset, we will certainly look at it.
Okay. So I would jump over to Steve. Steve, is that true? Is that something you would say you can work into your strategy? This clearly focused approach where you really look on individual asset classes?
I'd agree with that. I mean, your slides talk somewhat to the story of how the market has been developing, and you show the volume of activity that's been going on. The opposite side of that same coin is the amount of capital that's been raised in the secondary market, and that's been doubling broadly every 2 years for the last 10 years. And the number of entrants has been more than doubling in that same period. And that maturity of the market forces some of the things you've been talking about. And the maturity of the market also comes through in pricing, your pricing chart. I mean, we would broadly say that prices have stopped going up and have stopped improving. They jumped massively over the last 4 or 5 years, and you saw pricing grow by about 10%. And those are the numbers you're seeing flattening out now, whether that's venture or buyout. That's pretty much across the piece. Portfolio assets have continued to perform very well, and you've seen the stock markets going up. So that's broadly come through, and cash flows have been great within the portfolios as well. So, it's now a very mature market with a lot of certainty about what's going on. So it really does, and we're going to come on to it, I'm sure, but it comes to specialization. And all those firms and we as well have to say, okay, in what is now a mature market where prices are very full, how do I find value? And I have to find value by looking at things which I believe I understand, and I believe I understand better than my competitors, and hopefully I can see a value opportunity that the vendor either can't see or doesn't want to wait for. And that leads you to looking at much more detail in the underlying companies and into those portfolios, looking to get further information. And then, therefore, you can get the comfort that you need to have to look at single asset deals and at single companies, because you're drilling down to a level of detail which gives you that confidence and comfort. So I think that's why you've seen this sort of single asset, single fund transactions with a number of companies in them, or even single company transactions, because the market is just leading everybody in that direction. Which I think brings to a point of just making sure you find the right buyer. And that's where someone like Sunaina and the intermediary market comes into play. Because maybe you do need to break your portfolio up in certain ways as a vendor to find those right buyers. That may be by strategy, maybe real estate or private equity, or we were talking earlier about timber funds even being a niche area. So you've got to break that up. And even within that, you might find that certain vintages are more appealing to certain buyers than other vintages, certain geographies, certain sectors within private equity. So you may break it up even further than that. So this sort of specialization and single fund deals becomes almost the only way to understand the portfolio and sort of get that value. And from our perspective, as a fund, we're building a fund anyway over a period of time. So we can put those single assets back into a fund and get the diversification. We don't have to buy that diversification in the portfolio.
Thank you. Nico, maybe twofold question. One is for your own organization, is that also a trend which is really relevant, that you focus on, for instance, particular asset classes? And I'm asking this question because we certainly still see a lot of traditional, let's call them traditional secondary transactions, where you have a fund of fund trying to dispose of its entire portfolio, or you have an institutional investor who wants to sell significant number of fund positions, and they simply don't care whether, most of the funds are private equity or venture capital funds, but if there are a couple of infrastructure funds or private equity real estate funds, then they're part of the portfolio. Their hope is to find a single buyer for the entire portfolio. If we have 2 or 3 buyers, it's getting more cumbersome. But they certainly would not focus on a particular asset class traditionally. So the question is, for you personally, for your organization, is that a trend you're seeing? And if you're looking at the market, is that something where you would say, well, yeah, interesting, but 95% of the transactions are still traditional transactions?
No, definitely. I think what we very much focus on is basically we try to build on the established kind of GP base that we have, or that we have built over the last 20 years. So I would say we are probably less specialized than Hollyport doing tail ends, or 17 Capital focusing on preferred equity. I think we are quite opportunistic within those types of transactions, but we very much focus on the underlying managers that we know well. So we started 20 years ago in venture, US venture basically, and a lot of those GPs are very difficult to get access to. They wouldn't really share information. They're very difficult when it comes to approving transfer from a seller to a buyer. So we're trying to kind of use that to our kind of advantage by really focusing on the assets that we know, or the fund managers that we are already an existing investor in. And I think that very much comes down to the point that Steve was just mentioning, that you really need to be focusing on the things that where you think you have an angle compared to other buyers, right? Otherwise, if we are approached on a portfolio that we don't really know well, I think it's very hard to be the best buyer. I think that's very much a function of an increasingly efficient market, that the intermediary community finds the best buyer for any type of portfolio or single line or single portfolio company, and really finds the buyer that actually has the confidence to pay up or pay a full price in an efficient market. I think it's tough to find a great asset at the massive discount, but you need to have more information and more confidence in what you're buying than other potential buyers, right? By knowing the manager better, knowing the portfolio better. And that's what we are trying to use to our advantage. Right? And that's also how we filter the deal flow. I mean, we've seen it before. I think the volume is very high currently. But with limited resource, like all buyers have to a certain extent limited resources in terms of kind of manpower and time to pick certain opportunities, and you need to very early on filter out and pick your battles. Otherwise, you're kind of you're lost, I would say.
Okay, Fokke, what is your observation? What are the main developments over the last 12 to 18 months?
I think that a number of trends are continuing. So the GP restructuring has been mentioned before. In addition, I think the use of continued use of leverage in the transactions, in the large and also now smaller transactions certainly stimulate prices for limited partners. I think in addition, also in the fund restructurings, you see some fund restructurings which are beneficial really for all stakeholders. I think there are other examples where not all stakeholders are aligned in the current market environment, where still transactions get done. And that's certainly an observation that we see both in Europe and in the US. And we try to provide with 17 Capital an alternative to these this wall of capital, and we have a slightly differentiated investment strategy in the fact that we invest only in preferred equity. So none of the clients we work with sell their portfolio to us. We provide them with either a dividend recap, accelerating liquidity on a pref equity basis, where they can extract capital from the illiquid assets, reallocating them to different parts of their portfolio, or alternatively provide them with additional capital to continue to invest, to build their portfolios and exploit the opportunities that they have. And this part of the market is where we are very active, where we find transactions that where we try to align all stakeholders, the limited partners, the GP, the team, and 17 Capital, and our investors. And that's a different part of the market where it's not always easy to find the transactions. So about 80% of our deal flow is generated by the team itself, explaining what we do, finding and identifying the opportunities for limited partners, for general partners, for teams, and helping them realizing their goals.
Thank you. One question I wanted to raise. Nico mentioned GPs which are reluctant to approve transfers. Quite interesting topic, because my personal observation is that in a way the market is just getting rougher in that respect. I mean, if a client asked me, let's say 2 years ago when the world was in order, when England would typically lose on penalty shootouts and Germany would at least reach the semi-final of international tournaments, in that world, when a client asked me, will I get in trouble when I try to sell my portfolio, my answer would have been, never mind, we certainly can negotiate a side-letter provision where we say the GP will not unreasonably withhold its consent, but in practice it's just redundant. I mean, you will never get into any argument or even legal dispute about that. And secondly, I have seen maybe 2 cases in my life where a transfer was not approved. The experience from the last deals is completely different. It's really, you know, it might happen by chance, but you know, we in the latest transaction, I think 6 out of 40 GPs answered, well, we don't approve transfers other than to existing LPs, full stop. And you know, that was certainly a starting point of a discussion. So my question is really, you know, have you made similar experiences? Would you share that view?
I know it's very interesting. I don't know what it's on. Yeah, I think we've seen 2 trends, and I think it's an interesting question because we have seen some GPs that have become more reluctant to provide transfers. In particular, some of the venture guys, they're very still, I would say, not as institutionalized as some of the large kind of buyout shops, and they just still see themselves as like a close group of like investors, like a club that invest together and are not really willing to share information. Also, there's a lot of kind of sensitive information that they're not really willing to share. We've also seen it on the large end of the market with some groups that have like a approved buyers list, right? And it's one particular group where we tried 3 times already to make it on the buyers list and we were not approved. Despite the fact that we also commit on a primary basis. But on the positive side, we also see some groups that become more and more institutionalized and just actually acknowledge that there is a need for liquidity in the market and that LPs might want to get out earlier, right? And they are really kind of helpful and facilitate the transfer. So we haven't seen a massive change over the last 2-3 years, but it's certainly an issue, right? So on the one hand, we can use it to our advantage actually, but we also suffer from it in certain opportunities on the buy side, but also on the sell side, where we are actually liquidating the tail ends of our portfolio. So last year we were selling one portfolio with 30 underlying GPs, and in the end it went into different kind of sub-pockets. We had to sell one portfolio as a whole, and then we had to deal with 4 or 5 GPs that were all super restrictive, and we had to involve them. They had to kind of introduce their buyers, and it was very, very cumbersome in the end to get it done. So it's clearly a bit annoying, but I don't really know whether a lot can be done about it, because I think the legals, the LPs are quite vague about it. They cannot unreasonably withhold, but I think that's quite kind of a vague.
Absolutely.
Wording, yeah.
And you wouldn't sue a GP to consent. I mean, it takes too long and it's probably ridiculous. Sunaina, is that experience you're also sharing?
Yes, absolutely. So now it's becoming more and more important as an advisor to understand the GP landscape and map which GPs are going to be restrictive or not, and know that before you go into a sale process. So you can advise your client on the process and say, listen, these 6 out of 10 are likely to be problematic. So what types of solutions should we think about to get you the liquidity you need? Should we think about a preferred equity solution? Should we think about some kind of synthetic structure, some kind of synthetic swap structure? How should we think about your liquidity solution going into it? Otherwise, if you say, right, we have to do a straight sale, then it's about knowing which buyers are going to be pre-approved by which GPs. And there is quite a good map out there for those who are in the flow of the transaction to know that, listen, Bain has its top 5 transferees, and Oak has its top 3, and so on and so forth. And to be proactive with the GPs at the start of the process and say, hi, we're working on a transaction in your fund 8 or whatever it is. Do you have any restrictions, or do you have preferred buyers that you want us to make sure we bring to the process? So if you do that and you have that mapped out as you walk into the process, that can certainly help avoid these pitfalls later. But as Nico said, we have many deals that will go, 2/3 to 80% of the deal will go to one buyer, and then there'll be these straggling GPs who have to go to the preferred buyer X and preferred buyer Y, and that's how it needs to get cleaned up. And that's fine as long as you budget the time and the resources to run that type of a process. In order to really try to mosaic out the best price maximization strategy for the seller.
One follow-up question on this point. Is it, Sunaina, is it very much on a case-by-case basis, or do you think there's an overall theme to, let's say, GPs being concerned when they're thinking ahead for the next fundraising, that they want to have a replacement investor that is willing to commit to the next fund rather than a pure secondary buyer who may just buy now at a discount and may be gone in the next fund? Or
Yeah, that's absolutely right, Tarek. I think what the big trend is that GPs are now very aware that this market exists. And some of them, as Nico says, some have now realized, okay, I've got to rubber stamp some of these sales because I have a 10 billion euro fund, and there is going to be some flow in the secondaries market every quarter in my funds, and I need to be okay with that within reason. But there are others who are saying, no, hang on a minute, I'm a 500 million euro fund, or I'm a more niche GP, and I want to have control as to what's happening in my LP base. And so I want to be able to have either right of first refusals or right of first offers built into my LPAs. And when it comes to ultimate transfer consent, I want to have that control. I don't want to, for example, for argument's sake, some will say, I don't want a pure secondaries fund in my LP base. Well, then you have to ask that conversation as to why. Do you think they won't be supportive in the next fundraise? Are you looking for a staple in the next fundraise? What's happening? And then you can have these informed conversations with them. By and large, those GPs just want to know that their LP base is going to be stable and they don't have a hole to fill next time they go out in fundraisers. Some of them have been caught out. We're working on one GP, European GP at the moment, who let around 30-35% of their NAV transfer 2 years ago, and now just has a very large hole to fill when they're going out to market for their next fundraise and wishes they'd done things a bit differently. So that is indeed the driver, but I think they have to also figure out, well, what you can't restrict it down to only a handful of buyers, because then you might get a seller revolt saying, I'm not getting price maximization because you're telling me there's only 1 or 2 or 3 buyers here for your stake.
Fokke, anything to add?
Yeah, it's quite interesting. I think we have a complete different experience here, because when we transact with limited partners, they're not selling, so they're not necessarily transferring their assets. We transacted with a US endowment in the beginning of this year. They had about a portfolio of about $130 million of net asset value. And this was a quality portfolio. This wasn't the stuff that they wanted to get rid of. This was the stuff that they actually liked. Nonetheless, they were considerate about portfolio construction, reallocating a little bit the weight within their exposure. So what we did is we recapitalized the $130 million of NAV with $70 million of pref that went to the limited partner. And we took over the uncalled capital in addition to taking over the management of the portfolio. So the LP didn't sell. There was no transfer. It was super smooth, very quick execution. The limited partner accelerated liquidity, but continues to keep the upside of the portfolio. Continues, importantly, also to, certainly on paper, keep the relationship with the GPs. If he changes his mind on or comes for the next fundraise, he can continue to build on those relationships. And the transfer was not necessarily an issue because the GP actually found it as very attractive that they did realize their liquidity goals, but didn't sell to a buyer that they didn't want to have in the fund.
Just one follow-up question on this. Sometimes, the LPAs are a little bit broader in that they even capture indirect transfers or synthetic transfers. All the LPAs will not have this language in, but some newer LPAs may have that. And so of course, it depends on each deal and on the LPA, but also whether you acquire some kind of security for the preferred equity you're giving for the financing, at which level of the investor. But do you also, in some cases, have to go to the GP and ask for consent, or are the structures usually a bit different, and so normally it doesn't come up because it's a higher level in the?
In our experience, some of the LPs have asked for going out to ask for consent from the GP, but that was more an LP-led kind of process because they want to make sure that all stakeholders are online. We haven't come across situations what you described where the LPA would prevent or forces us to do it. But in those processes where the LP has driven us into the consent process, our experience is that we got 100% consent from all the GPs, and some of the GPs are some of the best performing, largest, and quite difficult GPs in terms of transfers. Because of exactly that reason. They like that their LP is getting the liquidity that they seek. That's not going to change. If the LP is seeking liquidity, he's going to find it one way or the other. But equally, it allows the GP to continue to hold that relationship with him. And in this case, this is another transaction than the one I just described. The LP continues to go to the AGMs, he continues to be informed, he receives the quarterly updates, he continues to keep the upside of the whole transaction as well. So he continues to be invested in the portfolio. So it's really a hybrid between a secondary sale and no liquidity at all.
Very interesting. Steve, any final comments before we move on to the next part of the panel on GP consents? Do you?
Yeah, I mean, it's an increasing issue in the market. I think it's just very complicated. I guess the question starts with why is somebody looking for liquidity and what is the underlying fund? So, the first problem we still have in the market is fund structures, all structures as 10 and 2. And that's madness, really. I don't know what percentage of the industry actually liquidates its funds within that time frame, but I'm going to guess it's less than 10%. Right, and the average life of a fund now is something like 14 or 15 years. So, that's the first problem. The second problem you have is vendors, for example, who are forced to exit because they're fund of funds. And that's one of the main drivers we see for people coming to us with portfolios. Now, what are they to do? They're forced into an exit position in a time frame where the GP has not delivered on the commitment that they've made. And now the GP wants to restrict what they can do about that. And I think, that's a challenge. You've got restricted choice, you've got a list of people that the GP only wants you to sell to. You've got to test market pricing. Which one of these issues do you want to deal with first? So the next part of the equation you've got is fundraising. So if you go to your existing LP base and ask them to buy up old assets in your funds, then how does that impact your new fundraising? Does that take away from allocation to you as a manager? So there's a whole different part of the equation to think about. So I don't know what it will look like in the future. I think we're at a point in the cycle at the moment where GPs feel they've got quite a lot of influence. There's a lot of capital out there looking to invest in private equity generally, and there's been some good returns. So people feel quite confident about demanding some of these things, which may have been taboo 4 or 5 years ago, outside of maybe some of the top managers who have been doing it for a long time, and they may become more taboo again. I think if your funds are young and the LP is looking to liquidate while there's still a significant amount of uncalled capital, for example, or when you're doing an aggressive rollout still within your portfolio, then you may have a different discussion to have, and you may have much more right to challenge who the new LP is and how they fit into the equation when you've done so much work to select that LP base in the first place. So I think there's very much horses for courses in the market, and I don't think that it should be seen as something that is right all the time. I mean, breaking, in the same way as I thank Amos as an Englishman for bringing up football while I'm in Germany, and breaking that fourth wall a little bit. Breaking the fourth wall on this point it is to say that all buyers around this table probably, and buyers that I talk to, are approved transferees for some funds and not approved transferees for other funds. So of course, for those funds that approve Hollyport as a transferee and have a restricted list, I'm very happy with the approach, by the way, and you should carry on doing it. For those who don't approve us, then we should have a conversation afterwards, and I'll tell you why you should approve us.
That's a good point. They used to say, don't mention the war, and now I heard some of the British papers said after Germany lost against Korea, don't mention the score. Anyway, we're moving on to the second half of the panel, discussing a little bit in more detail, the ways.
Doesn't work.
Okay. It's not so important. I can do it verbally. Like any market, the secondary market is developing. Here we go. And you can see a little bit the history of the market, and it came from nothing. And now we are at a roughly $50 billion industry. And certain things picked up at a certain time. You can see drivers of secondary markets, like, for instance, the Volcker rule in the US and banking regulation. Banks used to sell a lot of portfolios. And somewhere in 2014, 2015, the GP-led secondaries came really into force. And now you see one of the latest trends here mentioned, secondaries in Asia and emerging markets. So the whole idea is the market is developing and diversifying, and so people are maybe finding value in different alleys, in different corners, and the different investment themes. We have on the panel at least 2 to 3 themes here, tail end and preferred equity, and maybe smaller buyout venture managers. And other people may look, the very large players may look for complexity. This was a little bit the theme of the last 2 or 3 panels we had, looking at fund restructuring, tender offers, and these kind of things. Let's talk about maybe your specialty. Again, Steve, do you want to say something about tail end?
Yeah, sure. I think the challenge, you just can't buy the market anymore. If you went back 10 years ago in secondary private equity, you could buy the market, and that just doesn't work. You can't just bump into value and opportunity. So everybody has to focus, and you've got to focus for a number of reasons. You've got to focus for fundraising, because there's a lot of funds out there, and investors have got to decide where to put their money. So you've got to focus for fundraising. You've got to focus for underwriting as well to that value point and value creation point. You've got to know what you're buying. You've got to underwrite that to very tight margins, and you've got to believe in where the manager and where the assets are going to go to from this point in time. And you need to do it to convince the vendor as well. We've talked about that, and to convince the underlying GP. You've got to convince them that they want you in the fund. And then we come to tail end, which is maybe a part of the market where a lot of people don't necessarily want to invest because they maybe don't see that there's any value growth left to be had, or that the assets have been stuck there for some time. So where's that liquidity event going to come from? Because otherwise the liquidity event should have occurred. And the way to do that is to spend time speaking to the GP. So you need to have that access. And if you don't have that access already, you're going to need to get that access, because information reduces risk, and to pay the sort of prices that the market wants at the moment, you need to reduce the risk of what you're buying. So you need to get that information, and you need to understand where those assets and where that manager's going with them. And in the tail end market, for us, that's very important. What we're trying to do in that tail end market is, once we've bought those assets or understood what those assets are with the GP, is work out how we can work with that GP. Because I think what you're finding often is you've got LPs who have had what they want from that portfolio and from the GPs and the assets within that portfolio. But I think by nature of the fact that the GP hasn't sold them, assuming that they are still good assets or can be good assets, the GP has another plan. And so that's our approach at Hollyport, is to try to spend time with the GP, understand what that plan is, and give them the confidence that by working with us as the investor, as the LP, and maybe increasing our position as the LP as we build the relationship with the GP and with the fund, then we can help them deliver on that plan. That means giving them the time to get the assets to where they want them to get to, perhaps giving them the capital, so putting more capital in, to give them the capacity to take the assets to where they want to, and reshaping the fund. So that comes to these GP-led restructuring deals, reshaping the fund as well, if that's needed, to give the GP the incentive and the time to get to where they want to. And that's something that you find a lot of existing LPs struggle with, because they feel that they're owed for where they've got to. And we take a different approach, which is, if we're working with somebody, we want to help them get the assets and us to where we want to get to. So that's why we kind of look to realign incentives if we think that's the right thing to do.
Many thanks, Steve. Maybe Fokke, you can say a few things about how your firm kind of started this preferred equity business, or was at least one of the very first players in this market, and why they found this niche.
I think it's and it's also the topic, a very relevant topic. We at 17 Capital think it's very important to be specialized, do one thing, do it well. And our firm was founded in 2008, halfway the graph of the last slide. At the time, there was secondary buyers, not in the same size, but certainly already quite developed. There was some bank debt available, very restricted, short maturities, covenanted, certainly not suited for LP kind of situations or GP fund situations with illiquid assets, with difficult liquidity profiles, and then a fixed maturity of a debt instrument. So this really drove us into this instrument, raising capital for deploying exactly in this part of the market, sitting between the secondary side and that bank leverage. So we raised in 2010 the first fund, 90 million, and since we've deployed about 1.5 billion across 40 transactions, exclusively focusing on this single, quite specialized product for a very broad range of opportunities. And I think in the current market environment, it's important to be somehow ahead of the curve, to be able to be selective in the transactions that you do. It's quite easy at the moment to deploy capital in the wrong, or it hasn't, I don't think it has ever been as easy as now to deploy capital in the wrong situations. So over the last couple of months, I think the last 2 months, we declined 3 transactions that were made for us in terms of structure, in terms of opportunity, but because we didn't believe in either the geography or the quality of the GP or the alignment of the team that needed to take care of the assets. And because we've specialized and because we focus on this, we see the deal flow, we see all the deal flow, or most of the deal flow, that we create ourselves, that make it allow us to be picky on the transactions that we like, and we can be very aggressive on those in terms of process, and enable us to decline the deals that we believe are too risky or do not add enough value for our investors.
Thank you. Nico, I mean, your firm is a bit broader in terms of approach, but you also mentioned, for instance, that you are very well connected in the US venture funds space, which is in a way also a niche, very important, very attractive, and often very, very hard to get in. And you do also, on the smaller end, some buyout transactions.
Yeah. No, I would say we are clearly a bit broader overall, through the fact that we started as a primary fund of fund more than 20 years ago, and that was basically the GP network that we built, and then later on we moved into secondaries, right? That's the way the firm has grown. So quite naturally, we built the secondary practice on the foundation of the GP network that we have, right? And clearly that's the angle that we try to play. So clearly US venture, I mentioned European small buyout. There you have some restrictive GPs, but I would say generally speaking, I don't think it's such a challenge, right? So that's a niche that's a bit more difficult to defend. I see geographies on the slide there. So clearly we also do quite a bit in Asia. We have local offices in Beijing and Hong Kong, and colleagues actually doing investment management out of those offices. So I think that's clearly a place where we also feel quite comfortable. It's quite difficult for me or for the team sitting here in Europe or in London to buy a Chinese kind of growth manager. I just wouldn't get comfortable. If you have the people locally on the ground and if they meet the manager, I don't know, 3-4 times a year, then that works, right? And so that's kind of how we try to kind of differentiate. But clearly, if you just focus on portfolio transactions, right, I don't think that there is much complexity, right? In just doing portfolio transactions, it's a question of cost of capital, both equity capital or the debt, right? And at the end of the day, of course, you also need to know what you're buying into there. But I think in the meantime, most buyers are used to things like deferred payments, earn-outs, structuring, different kind of things, right? So I think a lot of participants or buyers have actually kind of caught up with the so-called leaders in the space, right? And it's more and more difficult to differentiate in just kind of broad portfolio transactions.
I think it's a very good point that a few panels back we talked about complexity as a way to maybe differentiate yourself from others. But one reason of that was that some of these deal structures were relatively new. So at that time, if you were the first one to approach it, you had to break new grounds. In that sense, you were, for you at that point in time, complexity was a selling point. But as these larger portfolio transactions and even fund restructuring become more and more commodities and more people are doing it, then just because they're big doesn't make them complex. And people have seen, Nordic Capital and BC Partners. So things continue, and a certain market standard establishes at the same time that makes the know-how available to everybody. So it's true that what looked maybe like a complex deal is now considered a normal, maybe big but normal deal. So it's true that maybe complexity in itself cannot save the ground. Sunaina, any further thoughts on this?
Yes, I think you're absolutely right that that's specialization and stratification by buyers in the secondaries market is absolutely the way they create alpha. 3 or 4 years ago, we had a very simple grid of here's the list of buyers in the secondaries market and here's what they do. It's a very simple table. Today, it's a pretty complex grid as to who does what, because not only do you have the fund vehicles like these 3 buyers have, but I know folks like Schroder Adveq have a number of separately managed accounts, and then you throw in on top of that non-traditional buyers like Canada Pension Plan or Government of Singapore Investment Corporation, who are also buying only certain types of secondaries. You certainly have a very, from an advisor's perspective, a very complex ecosystem where you need to keep track of who is now looking at what. So apart from the specializations you've put up here on the slide and the ones we've spoken about here, I mean, there is a lot of specialization by size. Who looks at what size? Some specialize in sub 5 million euro secondaries. Some will not get out of bed for anything less than 50 million euro secondaries, and even then it's borderline. We've mentioned the stratification by geography, but we have a number of buyers. There are 12 buyers who buy only Asia secondaries, of which only 9 will do China and the rest will not do China, and so on and so forth. There are a number, especially in Europe, there are a number of buyers of certain size, fund size ranges of secondaries. So folks who will only do secondaries and funds less than €1 billion, for example. And then the one that's most interesting, also a trend we've seen in the last 12 to 18 months in terms of specialization, is the emergence of early secondaries. These are secondaries where the funding ratio of the underlying GP is sub 40%, or in some cases even sub 30%. They are known as late primaries, early secondaries, and we've had secondaries buyers like Adam Street raise dedicated pools of capital, and Ardian raise dedicated pools of capital to do nothing but early secondaries, and are constantly calling us to say, do you have secondaries in 2016, 2017 vintage funds, or even late primaries that can become early secondaries? And then, you mentioned very briefly, and we were discussing it before the panel, the asset class specification. We've got timber secondaries buyers and lots of different types of real estate secondaries buyers, but natural resource secondaries buyers, and so on and so forth. So what used to be a one-speed market 5 years ago or a two-speed market 3 years ago is now a multi-speed market, multi-dimensional in its interests and abilities to pull the trigger on various strategies.
That's almost a final word, kind of. Amos, do you have any final comment?
No, I think we should, because I think we have about 1 minute left and don't want to overrun, at least not too much. The final question is always the outlook question, and maybe we start with Steve again. Steve, what is your view? What developments do you expect, let's say, for the next 12 to 18, so maybe 24 months in the secondary market?
I guess dislocation is what I would suggest. Dislocation, or breaking down dislocation and information. I think that's what GP-led deals has been doing. It's saying, as an LP, the way you're going to get the best price is by making sure the buyers have good information and an ability to make the deal look how they need it to look. So, open up the door. It's about information. And I think you're going to see that more and more in the just standard secondary market. Portfolios are going to get broken up, as we've talked about, into very specialist areas. Therefore, those buyers are going to have better information. They're going to want even more information, and then you kind of maximize price. So I think you're just going to see a bit of a reverse of what people have been trying to do, which is to keep information to themselves. And I think you'll see it kind of opening up.
Thank you. Nico?
New themes, I don't know, to be honest. I think we will see clearly is that the market will become even more efficient. I think more bigger funds being raised, new market entrants. And I think a lot of what we discussed now are challenges also as a buyer, right? We said pricing is high, leverage is high, and it's very competitive. But I think the flip side of it is that I think the asset class becomes more and more liquid. Right? So even if you're a small family office and you're building a private equity portfolio of, let's say, of esoteric assets, you can get liquidity, right? And that's a very, very positive thing. So there is a buyer for, as Sunaina just described, there's a buyer for almost any type of asset, and I think that's a very big positive element, right, of an asset class that was traditionally considered kind of buy and hold and was considered illiquid. Whether it's exactly that the case if the market kind of turns or if the market environment becomes more difficult, probably not, right? I think then obviously liquidity will also be challenged, but still I think it will still be possible in the midterm to get out of these assets before the 15 years, right, that Steve mentioned.
Okay. Fokke, what are your expectations?
I think that holders of quality portfolios, quality assets, will continue to hold on to them. They will continue to look for capital, hopefully ours, to build upon those portfolios. To date, this year in the first half of 2018, we've deployed about 250 million. Only 75 of that has been accelerated liquidity. It's very much growth capital. I think that that's going to continue for the next 12 months.
Okay. And last but not least, Sunaina.
Yeah, I would say I'd say we hope to see and we'll probably continue to see two big trends in the next 12 months. So it'll be interesting to see when you come back here next year if these predictions hold out. The first is that I think I mentioned it at the outset that mid-market GPs are going to use the secondaries market as a tool, and they're going to do it proactively, taking the lead from Nordic Capital and BC Partners and Warburg Pincus and Providence, etc., saying we can use this market to do secondary staples, tender offers, etc., and take command of our LP base using the market and its efficiency and its volumes as a benefit to us. So we have seen some transactions now and more year on year, but it's still, we're only scratching the surface here in Europe as to how many GPs there are and how many have considered actually taking charge of a GP-led process. We'll see a lot more of those going forward. And the second is that the single asset deals that I was mentioning early on, we're going to see companies start using the secondaries market more and more as a tool to clean up their shareholder bases and investor bases, not in an M&A type of transaction, but actually using the secondaries market to get pockets of liquidities for former employees or certain preferred shareholders, and seeing if there's a more efficient way to use this market to get to their endpoints.
Thank you. Yeah, I think it's time to thank the panelists for coming and for participating in the discussion, and thanks to everyone out there for staying in and for listening in. And I hope you have an interesting afternoon, and we see all of you at our summer party tonight. Thank you.